If you've ever looked at your bank account at the end of the month and thought, wait, where on earth did it all go? Well, you're definitely not alone. It can feel like a total chaotic mystery, right? But hey, you are in exactly the right place. Welcome to This Explainer. Today we're building a step-by-step roadmap to wealth. And listen, this isn't about having some fancy finance degree or even genuinely liking math. It's really about taking that everyday financial chaos and turning it into absolute, crystal clarity using the exact same playbook as the top 1%.
So, here's our itinerary for this little road trip to financial independence. 1. Your financial starting line. 2. Demolishing debt and budgeting. 3. Saving and investing strategies. 4. Navigating big car purchases. And 5. The rent versus buy debate. Like I said, mastering these strategies requires absolutely zero advanced math. Let's hit the road.
Section 1. Your financial starting line.
Okay, so we can't possibly map out a route to wealth without being brutally honest about exactly where we're standing today. You've got to ask yourself this kind of uncomfortable question. Where does your money actually go? Now, most of us just look at our money month to month, but life doesn't really happen in neat, predictable 30-day windows, does it? You have to track a full 12-month period. It's literally the only honest way to capture reality. Think about it. That surprise set of new tires, your annual car registration, or those holiday gifts that somehow sneak through the cracks of your budget every single December. Looking at a full year, that gives you the absolute truth. Okay, let's dive into this. Once you've got a handle on those 12 months, you add up your net income. The actual money that lands in your bank account after the tax man takes his cut. Then, you subtract your yearly expenses. This reveals your ultimate financial truth, your income surplus or your income deficit. If that number's positive, awesome. You've got a surplus, meaning you have fuel left in the tank to actually build wealth. If it's negative, well, you've got a deficit. And let's be real about what that means. You are slowly bleeding money. You're working incredibly hard every single day just to go backwards.
And that ultimate truth brings us straight to your net worth. The formula here is beautifully simple. It's just your assets, what you own, like cash, investments, or property, minus your liabilities, which is just what you owe, like student loans or credit card debt. Now, your income is super important because it buys your current lifestyle, but your net worth, that buys your ultimate freedom. Seriously, take a second to let that sink in. And hey, if your net worth is deeply in the red right now, do not sweat it. What matters is the trajectory. From this moment on, we're getting that number trending upward.
Section 2. Demolishing debt and budgeting.
So, if financial freedom is the destination, your budget is the roadmap. But before we hit the gas, we absolutely have to clear the bad debt blocking the road. Now, there are two highly debated ways to do this. First up, the debt avalanche method. Logically, this is superior. You attack your highest interest rate debt first, which mathematically saves you the most cash over time. But then there's the debt snowball, where you pay off your smallest balance first, totally ignoring the interest rates. Why do people love the snowball? Because knocking out an entire card gives you a massive, quick psychological win. Which one's best? Honestly, we're humans, not spreadsheets. The absolute best choice is simply the one that keeps you motivated to actually take action.
Once that toxic debt is finally under control, you need a system so you never, ever go back. Enter the brilliant 50-30-20 rule. Just look at the breakdown here. 50% of your take-home pay covers your fundamental needs: rent, groceries, basic utilities. Then 30% goes to fun. Yes, a whole 30%. This is exactly why the system works. It's freeing, not restrictive. You're giving yourself explicit permission to spend on dinners out and hobbies completely guilt-free. Finally, that remaining 20%, that goes to future you. That means savings, investments, and building the real wealth we're talking about today.
Section 3. Saving and investing strategies.
Now, what's really interesting about this slide is how adding fuel to your wealth journey depends completely on your specific goal timeline. Just look at the sheer power of time here. We're looking at over a century of financial history for the S&P 500, which is basically an index of the top 500 companies in the US. If you invest your money for just 1 year, it's essentially a coin toss. The results are wildly unpredictable. But if you hold for 20 years, the data shows a 100% chance of positive returns. No joke. Historically, anyone who kept their money in the S&P 500 for 20 years never lost money, hitting a minimum return of at least 4% and usually significantly higher. A 20-year timeline practically eliminates market risk.
And this is exactly why your goal timeline completely dictates where your money should live. For short-term goals under 5 years, like an emergency fund or a wedding, the stock market is way too risky. You need that cash liquid and safe in a high-yield savings account. Medium-term goals, say between 5 and 15 years, well, they can endure a few market swings to grab some extra growth. But for long-term goals of 15 years or more, like your eventual retirement, keeping your money in cash is literally a guaranteed loss because of the silent thief known as inflation. To beat inflation and capture massive compound growth, long-term money absolutely must be invested.
But here's the catch. As you get closer to retirement, you don't have 20 years to wait out a market crash. You've got to protect the wealth you've built. So here's a beautifully simple way to shift your investments from high growth to high protection. It's called the Rule of 110. Let's walk through this slowly. Say you are 32 years old. Step 1. Round your age to the nearest 5, taking you to 35. Step 2. Subtract 10. You get 25. Step 3. That 25 is the exact percentage of your investment portfolio that should be moved into safe, stable bonds. The remaining 75% stays in equities, like the S&P 500. It is a completely effortless, mathematical way to naturally lower your risk as you age.
Section 4. Navigating big car purchases. Let's directly tackle one of the most massive, wealth-draining roadblocks in our daily lives, buying a vehicle. If you want to build wealth, you need a structured formula so you don't get ripped off at the dealership. So the crucial point is the 20 in this pillar. You must commit to at least a 20% down payment. If you cannot scrape together a 20% down payment in cash, you simply cannot afford that specific car. It's that simple. This strict rule protects you from instantly ending up with an upside-down loan. That's industry jargon, meaning you owe the bank more money than the car is actually worth the exact second you drive it off the lot, and it aggressively depreciates.
The second pillar of our vehicle buying formula is the 4. This highlights the absolute necessity of capping your auto loan term at a maximum of 4 years or 48 months. Listen, dealerships absolutely love to stretch loans out to 72 or even 84 months just to make the monthly payment look tiny and digestible. Do not fall for it. All they're doing is secretly destroying your budget by stacking thousands of dollars in hidden interest fees over the lifespan of that wildly extended loan. Keep it to 4 years, max.
Finally, the 10. This completes the famous 24-10 rule. You need to cap all of your vehicle expenses, and that means the loan payment, your auto insurance, gas, and average maintenance, at a total maximum of 10% of your monthly take-home pay. A car is meant to get you from point A to point B. It is not meant to eat up half your paycheck. If the 24-10 math just does not work for the car you want, you need to look for a cheaper car. Honestly, buying a reliable secondhand car in cash and investing the monthly difference into the stock market, that is the ultimate flex of delayed gratification.
Section 5. The rent versus buy debate.
All right, it is time to challenge the ultimate generational myth, the deeply ingrained belief that buying a house is always mathematically better than renting. We're constantly told renting is throwing money away. But, and this brilliantly illustrates it, look at the hidden sunk costs associated with homeownership. When you buy, you throw thousands of completely unrecoverable dollars away every single year on property taxes, mortgage interest, legal fees, and mandatory valuations. None of that money builds equity. When you rent, your sunk costs are incredibly straightforward. It's just your rent and your occasional relocation fees. You're paying for a service, housing, just like you pay for a gym membership or internet access.
Furthermore, buyers face the brutal, unavoidable math of the 1% rule. As a homeowner, you should expect to spend at least 1% of your home's total value every single year just on routine maintenance. Let's do the math. If you want a $400,000 home, mathematically you must budget $4,000 a year just to keep the roof from leaking, the paint from peeling, and the pipes from bursting. This completely validates renters. When you rent, you are entirely off the hook. When that incredibly expensive boiler suddenly gives out in the middle of winter, you just make a phone call to the landlord and go back to watching TV.
Let's move to the next concept and see how this builds, because the real eye-opener here is opportunity cost. Buying a house requires a massive chunk of cash up front, usually a full 20% down payment. That is tens of thousands of dollars locked into drywall and bricks. Historically, if you took that exact same pile of cash and invested it directly into the S&P 500, the compound growth of the stock market often vastly outpaces standard real estate appreciation over a few decades. By locking all your capital into a single physical asset like a house, you completely lose the opportunity to let that money snowball in the broader market. You always have to ask yourself what that down payment could be doing for your wealth if it were invested elsewhere.
Which brings us to the ultimate question to end this explainer. Renting offers incredible flexibility, lower baseline stress, and the potential for massive unhindered wealth generation in the stock market if you invest what you save. Buying, on the other hand, offers the priceless, deeply human psychological comfort of a permanent home that you can truly call your own, a place to paint the walls any color you want and plant roots. So what does this all mean for you? You have to ask yourself, are you buying for maximum financial growth, or are you buying for stability? The choice isn't just about the math on a spreadsheet. It's about exactly what kind of life you want to build.